Hello, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Back in May, with international airline capacity sitting at around 40%, and amid expectations it would rise to 60 to 70% by September, young people's travel plans were limited only by available flights and their cost. Nevertheless, their intent then and since has been unmistakable. According to Webjet, a genuine shift has occurred in the cohorts willing to risk travel, with 25 to 35-year-olds, the largest cohort of international travellers, having overtaken 45 to 55-year-olds who held that honour before the pandemic. Indeed, the trend is reflected in my own family, with my eldest son travelling overseas twice this year already, while my own travel for both work and leisure has remained domestic. With COVID impacting older Australians more severely than the young, the development is perhaps unsurprising. Overall, travel still remains well down compared to 2019, but it's changing, albeit there are some nuances worth calling out. This week, listed travel operator Flight Centre saw its stock jump more than 5% on the day it declared travel is recovering slightly faster than expected, and consequently, its losses should be smaller. The company upgraded its FY22 EBITDA profit guidance to a loss of between $180 and $190 million. Now, this compares to initial expectations for losses of between $195 and $225 million. Perhaps even more importantly, the company said the changes reflect a stronger than expected June quarter period where the company is in fact now profitable at the EBITDA level. Flight Centre's shares have rallied 14% in the last 6 months. Now, it doesn't seem significant until you compare it to the S&P ASX 200 over the same period. With the index down 0.5% over 6 months, the 14% gain for Flight Centre reflects a significant shift in sentiment towards non-airline travel operators. The company also reported strong demand at substantially higher ticket prices, resulting in total transaction volume of $10 billion for the year, which was better than many analysts had anticipated and equated to 42% of FY19 levels. Now, on a monthly basis, a number of Flight Centre's businesses are in fact tracking at or above pre-COVID levels, which is encouraging, but gross margins have some room to catch up to pre-pandemic levels. This is due to the mix of travel, with the company revealing a greater weighting to domestic and corporate travel, while the rising international travel is dominated by visits to friends and family, which lacks the opportunity for the company to upsell clients for further journeys or superior accommodation. Flight Centre's previous key profit metric was net profit before tax, and despite the improving financials, the midpoint of second half guidance suggests a net profit before tax of just under $90 million, I should say a loss of $90 million. And to be fair, trading conditions remain tough. COVID infections and hospitalisations are accelerating again. Finding and training staff is complex. There's a shortage of travel agents, airline, airport and hotel staff. And airlines, as I mentioned earlier, are limiting capacity while commissions on international travel are under pressure. This has prompted some analysts to suggest a full recovery to FY19 levels may not occur until 2025. And remember, the company issued a lot of shares to survive at the commencement of a COVID pandemic. Flight Centre will report its full year results on August 25, and investors can expect an update on conditions in the travel industry, as well as the company's outlook. Meanwhile, the tussle between short sellers who believe the share price is prematurely pricing in a recovery and retail investors who are buying the recovery theme will continue. That's all we've got time for today. Look forward to talking to you again next week, and in the meantime, please follow us on Facebook and Twitter.